Hello, everybody, and welcome to our discussion on the cash flow statement. This is the introductory video in a series of videos that are going to be discussing the cash flow statement, going through practice exercises and things like that. So for this video, we're just going to introduce it, talk about some of the overview, give you a few examples, and we'll discuss it in more detail later. So the first thing I wanted to mention is that a lot of times when an investor is looking at the cash flow statement, they look at it in conjunction with the income statement. Now, these are both period of time statements, but they certainly serve completely different purposes. The cash flow statement obviously takes a look at how cash is flowing into and out of the company for what reasons. It's not just analyzing what the change in cash is, it's talking about three main categories of these cash flows. So again, it's cash, whether you borrowed the money, whether you issued stock, whether you're paying back a debt, whether you're buying equipment, collecting from customers, paying off bills, all those different types of cash flows are going to be represented in the cash flow statement. The income statement, on the other hand, shows revenues and expenses, which at first glance you might think, well, hey, aren't revenues inflows of cash and aren't expenses outflows of cash? And the answer is that generally they will be at some point. So, for example, when you have a revenue, that will lead to an inflow of cash, hopefully, at some point, but it may not be this period. It may be another couple of months away. You may not ever collect it at all. It may be a bad debt. So revenues, certainly a company hopes those lead to cash inflows very soon. And expenses, they generally lead to cash outflows. In fact, some cases they may have led to a cash outflow before the expense was even recognized. We talk a lot about that in the adjusting entries section. But expenses at some point lead to cash outflows, either earlier or later or right at the same time. So that's the difference here. One of the main differences between these two statements is simply the timing of when the flow happens. But the other thing is that there are some items that show up in the cash flow statement as inflows or outflows, but don't actually reflect a revenue or expense. For just a quick example, if you borrow money, that's a cash inflow, but that's not a revenue by any means. And furthermore, when you pay that money back, that's not going to be an expense. So that's just one quick example. There are others, though. Now, the other thing to note is that if this company's putting together a financial statement, a cash flow statement, we're always looking from the company's perspective. So is the cash flowing into the company or out of the company? If the company is paying cash to somebody else, then it's an outflow of cash. We're going to talk about the categories, but it's an outflow of cash, or sometimes known as a use or a purpose. If the company is receiving cash for any reason, then it's a source of cash or an inflow of cash, and again, we'll talk about those categories. And here we have those three categories. These three, as you're looking at the cash flow statement, this is like one of the most important things to be able to understand before you start developing a cash flow statement, or even before you start analyzing a cash flow statement, is what three categories do we have and where do the various cash flows fit. The operating cash flows they should be by far the most commonly used cash flow. They would happen much more frequently than the other two. The operating cash flows, these reflect the core operations of the company. In other words, what they're in the business of doing. Inflows, outflows, inflows are going to be collections from customers mainly. Outflows will be paying off various bills. We'll see the details in just a bit. Investing, now a company, when you think investing, you tend to think of, hey, I'm investing in stocks or bonds. And we'll see that, yes, that can certainly be an investing cash inflow or outflow. But you can also have other long-term assets that the company is investing in to help themselves grow. So it doesn't have to be a stock or a bond per se. It could be equipment for the company to grow. A long-term asset, the purchase and sale of long-term assets. Now, somehow the company, at least initially, has to finance their operations, finance their investments. So these are the financing cash flows. Now, these are selling the company's own bonds or stocks. In other words, issuing bonds out to bondholders, issuing stock to new shareholders. That's how they finance their operations. And of course, buying them back or paying the debt off. Borrowing basically falls under financing. So let's look at some detailed types of cash flows that fall under these three categories. With the operations, I gave you a couple of them. Receipts from customers. By far, this should be the most common operating cash flow you have. In fact, over the company's life, this should by far be the most common inflow of cash, period. A company can't operate by borrowing money, just borrowing more and more and more money, and they can't operate by selling all their equipment because eventually you run out. Operating cash flows, receipts from customers, it's the only truly sustainable cash inflow a company can have throughout its life. Now, the other thing, there are some other ones that normally come in. If they have stock, if they invested in stock of some other company and they happen to receive a dividend, under U.S. GAAP, the U.S. rules for accounting, this would fall under the operating cash inflows. Receipts of interest, so if they have a bond of another company or they lent some other company money and now they're getting interest back, these two inflows, dividend inflows, interest inflows, are operating under U.S. GAAP. Now, payments of interest, if you're borrowing money and paying the interest back, that's also an operating cash outflow in this case. Now, here's the piece that's missing. We talked about both inflows and outflows of interest being operating. We talked about inflows of dividends being operating cash flows, but the outflow of dividends, when we have stock and we're paying a dividend to our investors, this is not an operating cash flow under U.S. GAAP. It's a very unusual thing how they've categorized these. You could ask yourself, well, why are the two different interest flows operating and only one dividend flow operating? Very good question. There's not really good reason for it. It's how the U.S. GAAP established it, years and years ago. But here's the other odd thing. So again, this is U.S. GAAP, what U.S. GAAP requires for the cash flow statement. But the other odd thing, when you look at international standards, they do this a little bit differently. And to be honest with you, the international standards in this case are, in my mind, more logical. They basically say since interest when we borrowed money, that was our way of financing our operations. So when we're paying the interest back or when we're paying the dividends out, because those both related to financing purposes, we issued stock or we issued bonds and now we have to pay interest or dividends, international standards say, well, let's treat this as a financing cash outflow, which to me makes a lot of sense. But I don't want to confuse you. U.S. GAAP does not allow that treatment. International standards also say if we receive dividends or we receive interest, hey, that related to some investment we had, so it's an investing inflow. Again, makes all the sense in the world. It's just not allowed by U.S. GAAP. So the easiest way to memorize this under U.S. GAAP until at least they change it is that whenever you're talking about dividends or interest, by default, assume that it's an operating cash flow, but then you just have to remember that payments of dividends go under financing, as we'll see just a bit. Investing, really, again, it's any long-term asset, whether it be a stock or a bond of another company that you're holding as an actual investment, or just equipment, land, buildings, anything else, long-term asset that you're holding in the company. So if you're investing, if you're buying one of these, you're paying cash, so it's a cash outflow. If you're selling it, you're getting cash in. It's a cash inflow. Pretty straightforward here. So financing, again, how are they financing their operations and their investments? They're either issuing stock, buying back the stock, uh, borrowing money, or paying back the debt, whether it be a bond or a note or however they're borrowing. When I said they buy back the treasury or buy back the company stock, a lot of times that's called treasury stock. There are other ways to do it, but that's the main concept. And again, the odd thing under U.S. GAAP is that only the cash paid to stockholders for dividends is considered a financing cash outflow. So, we've talked about these three categories, very important concepts there. But now let's take a look at three companies that have the same total cash flows for this period. They all three have $30,000 positive cash flow. So at first glance, it sounds like it's a good thing. They're all positive. They've all increased their cash position. But the question is, are these three companies equally healthy? And before we get into this, the first thing I want to mention is that different companies at different stages of their life cycle are normally going to be different for very good reasons. So I want to kind of explain as I go through these companies which stage of their life cycle they may be in. So let's take a look at Company A. Again, they all ended up with 30,000 positive, but they got the money from different places. For Company A, the operating cash inflow is $125,000. A positive amount for operating activities is always a good thing. A negative amount is not a good thing. That means they're not able to collect enough from customers to pay their bills, basically. Now, it may happen in the short run. A brand new company, they may have trouble building up a market base. But for a company that's been around for quite a while and is now successful, which I would say Company A is, they should be generating a very good positive cash flow from operations. So that's always a good thing. But hey, now we take a look at investing and financing. And both of these are negative numbers. Now, negative sounds bad, but what I want to say here is that for these two activities, negative is not a bad thing. In fact, it can be a very healthy thing. What a negative cash flow is for investing and financing is that for investing, they may be spending money to buy new long-term equipment to grow. A company that invests in themselves and grows down the road may be able to generate even higher operating cash flows in the future because they have more operations going. So a negative now may lead to bigger positives in the operating cash flow down the road. So negative is not a bad thing for investing. They're growing. Financing, a negative basically means they're paying off debt. That's an easy way, or they're buying back stock. But this is a healthy thing. This company is contracting their financing. They may eventually be able to run off of their own financing through operations. That's really the goal of a company, is to be able to finance their own operations and grow that way, grow normally instead of having external financing. That's a perfect situation for a company to be in. Now let's take a look at Company B. They had positive operating cash flows, but not a very big amount. They still needed to get to $30,000 total, though, so they did that by having two positive amounts in investing and financing. Now, again, you might think, well, hey, positive for investing and financing, that must be good, right? With investing cash flows, positive essentially means that you sold some of your investments in order to generate cash. Now, if those investments, if you're selling them just because you don't need them anymore, or it's the right time to sell, then hey, that's fine. But if the company continually has to do this just to generate enough cash to survive, that's absolutely not a good thing. They're shrinking in size. And again, you only have so many investments you can sell before you're out. Financing, this basically means they borrowed money or they issued stock, which again, if a company is early on in its life cycle or if they're trying to grow, this may not be a bad thing, but you can only do it for so long before you're no longer able to borrow money, you're no longer able to issue stock. It has a limit. Now let's take a look at company C. They have a negative for their operating cash flows. Again, this means that they weren't able to finance their own expenses through operations. They weren't able to collect enough money from their customers to pay off their bills. So that's not a good sign right off the bat. Again, maybe it's early in the life cycle, and that might not be a horrible thing. But if this is after the company's already been successful, then this is a pretty big red flag. But to make up the $30,000 positive amount, they had to sell a lot of their investments, borrow a lot of money just to generate $30,000. Again, not a very good situation for Company C. Hopefully they're able to turn something around. So we have those three categories. When we look at the cash flow statement in just a bit, we're going to see that we actually have two different methods that can be used to determine how the operating cash flows are going to look. Now, I will say that the investing and financing sections of the cash flow statement, they don't even really give them a name. They don't really give the method a name because it's essentially the direct method. There is no other choice. But for the operating section, they give it this name because you have the choice of using the direct method or the indirect method. The direct method, we're basically taking a look at the cash account and identifying where those cash flows went. We're trying to categorize the transactions. We don't have a list for every single transaction. We put them into pretty broad categories. Collections from customers, payments for certain expenses, things like that. Now, again, we want to know if they increase or decrease cash. We're going to get into the direct method in much more detail in another video, but for now, we're just going to broadly say that. Now, here's the thing I want to mention with the direct method. If you use the direct method, which, by the way, the FASB strongly recommends that companies use the direct method, but they also say if you use the direct method, you're also required to complete a reconciliation between net income and the operating cash flow. Now, the problem with that, and the reason that over 97% of the companies in the United States do not follow the FASB recommendation to do the direct method, instead those companies use the indirect method. The reason for that is that the indirect method, one of the reasons for that is the indirect method is the reconciliation between net income and operating cash flows. So essentially it's either you do the direct method and the indirect method, or you just do the indirect method. For obvious reasons, companies choose the indirect method. It's less work. But the other reason about that is that the direct method, which we'll see in a later video, provides a lot of detailed information that, yes, it may help the investors, but the problem is it may also help your competitors compete more effectively against you. Sometimes knowing too much detail about your operations helps them plan to better compete. So it just makes it harder to operate. That's the other reason why companies tend to not use that direct method. So the indirect method, again, it's only for operations, and we basically start with net income that is under the accrual basis of accounting, and we start backing out adjustments or making adjustments to back certain things out, to add certain things in, depending on the timing of when they should be treated as a cash flow versus when they were impacting net income. So we're going to spend some time in this video talking about the indirect method, but we'll also see examples in later videos. So again, some indirect method adjustments are just due to a timing difference. Some of them are due to the fact that this is not even an operating cash flow, period. So we're trying to adjust from the accrual basis of accounting to the cash basis. And we're going to see three adjustment categories here. The first one, we have gains and losses, usually on sales of investments. Now, the thing about this, we just said earlier that the sale of an investment is actually an investing cash flow. So we don't want it in the operating cash flow. It just doesn't belong there. It's an investing cash flow. That's one reason. But the second reason is that the gain and loss is not the full cash flow. The sale price is the full cash flow. The problem is that gains and losses, they did impact net income. We know that gains would have increased net income, losses would have decreased net income, but we don't want them treated as operating cash flows, so we have to reverse the impact. In other words, since gains increased net income, we need to subtract them out of net income to basically back that number out, to reverse it. Losses decrease net income, so we need to add it to reverse it. That's the adjustment we need to make. Adjustment number 2 is perhaps even a little bit easier. Depreciation, amortization, depletion, those are all non-cash expenses, non-cash in that period. The reason is that, let's take depreciation. We purchased a long-term asset in year 1, and maybe this asset is lasting 20 years. We didn't count the full cash flow in year 1 as an expense. Instead, we depreciated over time, over the life of the asset, and the expense gets spread out on the income statement. The problem is the only cash flow happened in year 1, and again, that would have been an investing cash flow anyways. So we would have reported that full purchase price in year 1 and not in any other year. But since depreciation and all of those are subtracted out of net income, they're reducing net income every single year of that asset's life, we have to reverse it by adding the amount back in. So the depreciation, whatever we see on the income statement, we have to add that amount back in this reconciliation to reverse it out. The third category takes a little bit more discussion and a little bit of memorization, but there are some tricks to it, and we'll talk about that. Adjustment number 3, which is actually several adjustments, it's just a category. We take a look at all of our current assets, except for cash, because cash, we're trying to figure out what the cash is. We're trying to back into cash. So we take a look at the changes in all the other current assets and all the current liabilities from last year to this year, or I should say last period to this period, and we try to figure out what does that mean as far as the income statement, and what does that mean as far as the cash flows. So current assets and liabilities, often they're used when we're recording expense at a different revenue or expense at a different time than when the cash flow changed hands. This is all required under the accrual basis of accounting. We talk about this a lot in the adjusting entry videos. For example, there are just a few examples here. When we have a salary expense, so employees have worked for us, we're going to record the expense, but it may not be a cash flow at that time if we haven't actually paid it yet. Payroll doesn't happen for another week or so. So we use salaries payable. So the salaries payable, the current liability, changes because there was no cash flow yet. If we would have paid that salaries expense right away, we wouldn't have touched salaries payable. We record accounts receivable when we record revenue that we have not yet collected. We record prepaid assets when we first buy assets like supplies or whatever, and there hasn't been an expense yet. So we take a look at these changes. These are just 3 out of many examples of current assets and current liabilities. We take a look at how they've changed, and we try to figure out what does that mean as far as the cash flow. Is more cash coming in? Is more cash going out than what was recorded on the income statement? So the little chart here, it's not really a chart, it's just a few bullet points, but there are four different things. Again, we have current assets and current liabilities. So was there an increase or a decrease to each of those items? So you go down your balance sheet and you take a look at all the current assets and current liabilities and determine whether there was an increase or decrease. If there was an increase to current assets, we have to do the opposite to back it out of net income. And I'll explain a few examples in just a bit. So increases to current assets result in a subtraction or a decrease from net income. Decreases to current assets require an increase to net income to get this cash flow. So what you can take away from that is that whatever happened to your current assets, do the opposite to net income. If you increase the current assets from year to year, decrease it out of net income to figure out what the true cash flow is. Now, current assets and current liabilities are opposites, so you can imagine they have the opposite impact. Increases to current liabilities increase net income. Decreases to current liabilities decrease net income. So, really, if you remember one of these four items, and just remember that assets and liabilities are going to have opposite impacts, then you can back your way into this entire chart. But let's talk about why some of this is. Assume that we had an increase in accounts receivables. What that would mean is that we had a lot of net income that was recorded on the income statement, but guess what? We didn't actually collect it all in cash because it's still in accounts receivables. So there is some net income that did not get a cash inflow, so we have to back it out. And likewise, if the accounts receivables dropped, then what that would mean is we're collecting more cash that period than what was recorded in income that period. For current liabilities and the expenses, let's take a look at salaries expense and salaries payable. That's our classic example there. If we had a salaries payable that increased, what that means is, hey, we apparently recorded salaries expense that period, but guess what? We didn't actually pay it because it's in payables. So salaries expense would have reduced net income, but it did not reduce cash flow yet. So we have to reduce that amount back out to show the true cash flow. We don't want it to look like that expense led to a cash flow. It did not this period. So now let's take a look at the two. And again, this is just a high-level illustration of these two methods. We're going to see these in more detail in later sections. But the direct method, you'll see your operating activities, investing, and financing. And then, by the way, at the end, for every category is going to have a subtotal, either cash received or cash used. And then we're going to get a net increase in cash or decrease potentially. It's just the addition or the sum of these three subtotals. So here we had a $3.2 million increase in cash. We add that to the beginning cash balance, and that tells us what the ending cash balance should be. This should certainly match what is on your balance sheet for cash. But again, with the direct method, notice that there's no net income here whatsoever. It's just a list of cash received or cash paid for various purposes. Same with investing, same with financing, cash received, cash paid. Under the indirect method, the investing activities and financing activities are all the same. The reconciliation portion at the end is the same, and in fact, the final number has to be the same amount. In fact, the whole reconciliation has to be the same amount. Each of the subtotals have to be the same. The only difference is how did you arrive at the subtotal for operations. Notice that it's $2.9 million in both cases, but under the operating activities in the indirect method, we start with net income from the income statement, and we add and subtract various things based on the rules we just talked about a bit ago. So that's just an illustration of what the statement of cash flows looks like under both methods. We are going to spend some time in the next few videos talking about examples, going through detailed examples about how to analyze the cash account, especially for the direct method. We're going to talk about each of those things I just briefly discussed with accounts receivable, the payables. We'll even get to the complexities of inventory and accounts payable. That's one of the more complex ones because two different things are going on at once. And again, we'll see that in the next video. We'll go more into the direct method, and then in later videos we're going to have examples of cash flow statements that we will put together. So hopefully this has helped to explain the cash flow statement at a high level. I thank you for your time, and I hope you have a great day. I will talk to you in the next video. Thank you.